Hi guys, welcome to the second video of our series. Today we focus on the token economics of H2O Securities. So without wasting time, let's jump right in. Our agenda for the session is the total circulating supply cap, types of equipment that we are using, and our token economic model. You might be familiar with this section on our website. This section shows all of the tokens in distribution, including those that are still investing. It also shows the date of next year, July, to be the final date where all the vesting contracts have been completed. This brings us to a total cap of about 50 million tokens in circulation. I would like to make that a hard cap for the time being and only to be changed under certain predetermined conditions, which I will share with you during the course of this video. We've had this question a few times: how does a water plant look? I'm going to share with you three categories of water plants. The first category is the micro and the small plant. The second category is our medium-sized plants, and then the third category is the mega-sized plants. This is how a small or a micro plant looks like. They produce between 10,000 and up to 50,000 liters of water per day. Exactly the same size as our POC of last year. If we were to supply the current shortfall of the world with these kinds of plants, then we will have to install up to 2 million of these plants around the world. This shows you how a medium-sized plant typically looks like. These plants produce between 5 million and right up to 20 million liters of water per day. If we have to supply the current shortfall to the world with these kinds of plants, you would be looking at deploying about 75,000 of these plants around the world. On the other hand, this is a mega plant. These mega plants produce between 200 million liters per day and up to 3 billion liters of water per day. They are truly large scale, using complicated technologies, complicated structures, and so forth. This is not the kinds of plants that we are involved with. We are predominantly focusing our entire business around the micro plants and the medium-sized plants. We have our entire risk modeling, tokenomics, and financial modeling has been designed around that category of plants. Let's look at our token economics. And I'm going to make it as simple as possible. So on that note, on every dollar that we invest in capital equipment, or CapEx as it is called, roughly between 0.03% and 0.1% is returned on a daily basis as the plant produces water as yield to the company. That range of 0.03 to 0.1% depends largely on the kind of technology being used, the environmental conditions, the types of water, and so forth. You can imagine if you have a business such as ours where you keep adding water plants more and more, that daily yields will grow more and more and more over a period of time, giving you a really good return on investment. The second thing that we have to consider is that we use a blended means of finance. That means we are using fiat currency and the H2O in currency. At this stage, our ratio is 90-10, and over a period of time, we want to grow that to a 70-30 ratio. Taking these ratios into consideration, you can use the following formula: that roughly 0.02% of the capital value is converted on a daily basis to USDT that is used to purchase H2ON from a decentralized exchange that gives you the value increase of the token. That is the base formula that you can use. What does this mean for us? Today, the shortfall to finance water scarcity is about $200 billion per year and growing. If we aim to achieve 0.5% or 0.5% of that market over a 10-year period, then it means that we would have funded about $1 billion in capital equipment. Now do the math around a 0.02% on $1 billion of capex invested. That is our aim, that is our target. On this graph, let's see if we are completely mediocre and not achieve our growth targets, and we only manage to invest $20 million over the next 10 years. What is the impact of that $20 million on our 50 million tokens in the market? Let's look at that. I want to use this chart to illustrate three very important aspects. On the x-axis, various price points of the H2O tokens starting at 20 cents, ending at $2. On the y-axis on the left-hand side, all the tokens in circulation, which is currently capped at 50 million. The first very important thing that this chart shows is as follows. If we have $20 million of capex deployed, then at a price point of 30 US cents, there is a demand for 100% of the H2O tokens consistently. That means for every token that's out there in the market right now, there will be a demand. The second very important aspect that I want to illustrate on this chart is that we can stimulate a price movement to the right, meaning to the dollar plus mark. There are two strategies to achieve that. The first strategy I'm going to discuss with you in a lot more detail in our next video. But the second strategy is a token burn strategy. Every single day when those plants operate and produce water and our smart contracts buy back the tokens from the market or from the DEXs, a certain ratio, or the smart contracts will burn a certain ratio of those tokens until the price increases to $1.50 mark. That gives us a programmatic or an immutable means of stimulating or managing the price in a very narrow band of between $1 and $1.50 as we add more plants and need to produce or issue more tokens to produce more plants. This chart is important. It shows our strategic intent on how we issue tokens. If we want to maintain our token price between $1 and $1.50 at various capex levels of $100 million, $200 million and more, how many tokens can we issue without breaking our 1-to-1 rule? Meaning for every token that we issue, there will be 100% demand for that token during any 12-month cycle. What this illustrates is that we cap the amount of tokens that we issue based on the price band and the capex deployed. Tokens are not issued without taking those factors into consideration. Notwithstanding all the engineering that we put into the tokenomics, it is still dependent on market forces that we cannot control. That means you can still get a person that just dumps all of its tokens and have an adverse effect on the token price. However, it does also show that even though that happens, during the course of a 12-month period, there will be still a demand for all of those tokens. Guys, thank you for watching this video. I know there will be a lot of questions. We are planning to host a webinar, an interactive webinar where these questions can be asked and answered and so forth. Always feel free to ask questions on the Telegram, and thank you for your support and your continued support for this transaction and for this business.